Okay, I want to show you the difference between a 5-year fixed and a 5-year variable. Each moment in time, there's some advantages to the fixed versus variable. And sometimes there's moments in time that a variable seems a lot better than fixed. Right now, my strong opinion is that a variable, if you can get a prime minus, is much more advantageous than the 5-year fixed. And the difference can be um, fairly substantial, way more than most people assume. So, and the downside is very minimal. So here's an example. If you look at option one, if you can see that here on a $500,000 loan. Now, if your loan is smaller than that, the numbers will just be proportionately smaller. But a 5-year fixed is an option one at 2.94. That's where Royal Bank is, and a lot of our lenders are moving to. Compared to the variable we have right now, which is prime, and prime is, I'll type it over here, is 2.95. So prime at 2.95 minus 0.8 is 2.15. Currently, we have one lender that's prime minus 0.85, which is 2.1, but that's for high ratio only. And we can hold that rate for 4 months while you shop. So if you're shopping, I would lock that in. Now, here's the reason why. A lot of banks over the last 3 days have jumped from 2.1 to 3.1, which means they've taken the prime minus right out of the equation. And in fact, some are prime plus 0.1. So that happened during the 2007-2008 crisis. And normally when liquidity dries up in the markets, banks can't hold that prime minus. Now, another reason that they're dropping their prime minus is because prime looks like it's going to fall 50 or 75 basis points, again, from the Bank of Canada. So if that happens, that 2.1 rate may go to a 1. It depends if the bank passes all of it over or not, but it could be a 1.6. It might even be lower if the bank drops 75 basis points. But in this case, you can see a 294 compared to a 1.6 if we do get that drop. Lowers your payments by $320 a month, $330. And look at the interest savings is 31 grand over 5 years. Now, people may say, well, prime may go up over time, but I'll just show you the savings in the first year. If that happens, that drop happens. It's $6,500 pre-tax per year. And what pre-tax means, and I can lower this a little bit, that means that you have to go to, in order to get that $6,000 to pay the bank that extra interest, you have to make $8,900 at your job, pay tax on that, the federal tax, the provincial tax, in order to get $6,000 to make up that difference. So when you can get a better rate on a better interest rate, you're actually saving more than you think, because we're dealing with after-tax dollars. So in salary wise, you have to make $8,940. So basically 9 grand in salary a year to make up for this difference. Now, some of you are going to say, well, wait a second, we can still get 2.69 on the market. And there is a couple banks left at that. They're moving quickly. But even at 2.69, you're saving 5 grand a year, which is roughly 25 grand over a 5-year period on a 500K mortgage. Now, some of you may say that, wait a second, prime hasn't dropped yet. So we'll go back to 2.1 and even 2.15 for conventional. So even if you got the best 5-year fixed, and even if you say that prime is not going to go down again, you're still saving over $2,500 a year now, and your payments have dropped roughly $150 a month. So there's some substantial savings right now in terms of taking a variable. And the U.S. has dropped their prime rate to 0. Canada's usually pressured fairly strongly to follow suit. So there's a high probability of getting down to, let's even say, a 1.75 rate. So really you're looking at $5,000 savings every year, saving $200 to $300 a month on your payments. And there's usually, in these crashes in 2007 and 2008, it took quite a while for the Bank of Canada to start raising prime. So you likely will get 2.1 to, let's say, a 1.75 to a 2.1, depending on what Bank of Canada does. But you should have that for the next 2 years to 3 years. But let's say the Bank of Canada did not lower the rate and you have a 2.1. The third year, they start raising 25 basis points, so you go to 2.35. On a 2.35, you're still saving $1,500 a year. And then they raise again the next year, so 2.35 goes to a 2.6. You're still saving $500 that year. So now we're in year 4. Now, let's assume you got a 2.69, and the bank rate goes up again to 2.85. So assuming we didn't have a drop, and assuming that Bank of Canada started raising rates in year 3, you would have lost $785 in the last year, but your savings would have been over 10 grand before that. So the variable, I don't see any. There's always a possibility, but I just, there's enormous pressure for Bank of Canada to lower rates, not raise them. Being in a fixed rate now is just really has a high probability of costing you $5,000 to $20,000 in extra interest. In fact, I moved my mortgage to a prime minus 0.8 this week. I would recommend that as well, because at the beginning of next week, again, most banks are there, and we still have, for a short time, even on conventional, that. So 500,000, 2.94 compared to 2.15. That's $200 difference. You're saving roughly $4,000 a year, and this should be down to a 1.75. And if we drop 75 basis points, we might be down to a 1.5 in that range for a rate. Now, if it does drop to 1.5, which is my call, I think we'll be in that range fairly quickly. You are now $7,000 a month on this mortgage, or sorry, $7,000 a year. So now you're looking at over $30,000 savings over a 5-year period fairly easily. So the savings can be dramatic right now. This is only 2 times I've seen the window of opportunity right now, and it's only lasting roughly for another few days before all banks are at prime plus, so you won't get that 2.1 or 2.15 rate. So we can hold some of these even before you found a house. So my recommendation is get a rate hold. If you have a live offer, let's get another approval for the 2.15. If you have a mortgage right now, we can look at switching it and paying a penalty. One of the banks will add $3,000 of that penalty to the mortgage when you move it over, which reduces how much out-of-pocket penalty that you need to pay. But if you can lower your interest rates right now and get into this variable while we still have this window, I could recommend it more strongly. Now the risk is always there, so you may lose money. So you have to know that risk is inherent in variable, but the opportunity on what you could save is dramatic right now. Call me with any questions, and thanks for watching.